Oh, this is the podcast studios brought to you by Machine Inc. Welcome, everybody.
How are you?
I'm great. How you doing?
I'm doing awesome. Thanks for having me. This is a great studio. I'm learning a lot from you.
Thank you. That was just our headphones.
Okay.
Thank you. I appreciate it. I'm glad you came on.
Yeah, for sure. This is, we're trying to do something at my office, something similar, but this is top of the line. I love it. Like all the, bells and whistles.
Thank
Yeah.
you.
Pretty cool.
Yeah. I hope you call me after.
Yeah.
I like to build things. Anyways.
We won't make you build this table again.
Okay.
Yeah.
No problem. So, I know you got a lot going on.
Yeah.
Family man, couple kids.
Right. Two girls, 11 and 16. Older one just got her driver's license, so we're having fun with that. Yeah, it's good. But yeah, that's what you live for. Your family, right?
Absolutely.
Yeah.
So is it like a revert? Because I don't sleep now because I have a baby
Right.
ish. Is that what happens when they start driving? Or you sleep okay?
We sleep okay. Yeah, we make sure that they're home. She's home by a certain time. It's and then you've got the Life 360. You're always checking on where they're at. Funny, she got her license last week, I don't remember. One day last week.
Yeah.
She got it. Her and her sister, my 11-year-old. You got two of your kids in one car. First time driving by themselves. They go to Starbucks. You're all nervous and worried, checking where they're at, and then she's out like an hour after Starbucks, just driving around the neighborhood, just
Being a kid?
Being a kid. And, when you think about it, it's like, our parents growing up, they could not track us. So they didn't know what we were doing. And we were doing the same thing. Just, you get your license for the first time. You just want to drive around and,
Oh, yeah.
be an adult.
Right.
They're pretending to be.
You had to have a lot more faith back in the day, huh?
Right.
Just
They just let us go.
yeah. Good luck. Hopefully
Right.
you make it home.
Yeah. No phones, page, that was the thing.
Yeah.
Just send them a quick page and see where they're at.
Yeah, right?
Yeah.
With the Italian flag on the
Yeah.
on the clip,
Right.
bedazzled.
Uh-huh.
Those were nice.
That's funny.
Yeah.
Remember those days.
Yeah. That's cool. So, well, yeah, you've been doing it, and you've been doing, what's the name of your company?
So I'm with Fairway Home Mortgage.
Okay.
Yeah, I've been with them 8 years. I've been in the mortgage industry since 2001. So I've seen the ups and downs, and just
Wow. So you've been 24 years.
24 years. It's crazy. Yeah, I first started off in the industry
Mhm.
on the wholesale side. So, let me take a step back. So I started with a company called Household Finance. We were there for about a year. It was direct to consumer. We'd sell mortgages, personal loans, line of credits, that sort of thing.
Mhm.
They had a great training program, learned a lot, learned how to sell. And then I went over to the wholesale side. So we would go into broker shops, small broker shops back in the day. And
Okay.
that was during the subprime market when people, were doing 2-year ARMs or 3-year ARMs, adjustable rate mortgages at in the 8s and 9s. It was,
What's a subprime market?
So a subprime market is, someone with, a higher loan to value, or meaning, they're taking, up to 100% of the value of your home, or they have a lower credit score.
Oh,
So that was, the subprime market. And
the Big Short.
right, basically. Yeah. And, my job was to, go out there to broker shops and, sell my products and services and what we can do. And those brokers would deal directly with the consumer, but I'd have to find a home for the mortgage, meaning like what investor does it fit in? So I learned a lot during that job. And then I went over to retail, meaning, direct to consumer, where I was a loan officer,
Mhm.
and started that in 2004 with Bank of America home loans, and just, built my way. Been here at Fairway Home Mortgage for 8 years. So I've been up and down and, seen a lot.
Yeah. 2008 was a lot, huh?
Oh, it was crazy. Yeah, that was a wild ride. I mean, people, not only was it like you mentioned, the Big Short. Like, it was tough for us to get loans done during that period of time because there was a lot of uncertainty.
Oh,
So,
yeah.
yeah, it was wild.
I didn't even think about that. A lot of people now, well, obviously they changed the conditions because of what happened with that.
Right.
So then during that, no one probably want to give any money out.
Right. Yeah. They were, unsure what was going to happen. It was taken, like I remember at the end of my time at Bank of America, when Countrywide and Bank of America merged together. I mean, it would take 5, 6 months to get a loan done. There was a lot of uncertainty. I
Wow.
mean, that was, people were going up to 100%, stated programs. Now it's, everyone's verifying stuff now. It's just doing stuff the right way. But back then it was the Wild West, it seemed like.
Yeah.
Yeah, it wasn't fun, especially during that time period. Because as a loan officer, you know, we get paid 100. We're 100% commission, so we get paid on what we close. And there was a time period where you didn't make money for 5 to 6 months, so it was a tough time. Yeah, I was
Yeah.
considering getting out.
Yeah. Yeah. That was a rough time for
Everyone.
everyone.
Yeah.
Everybody for sure.
Mm-hmm.
How about so now you take in basically you have the consumer, they come to you, they're looking to buy a house, and you have a lot of products, right?
Right.
What's your most popular product? What do you think it is?
Well, when you're dealing with financing, mainly you're talking about conventional loan financing or FHA financing. We deal with a lot of first-time home buyers. FHA financing is a more lenient program where, it's less down payment, where, you can deal with someone down to a 580 credit score. Conventional loan financing, we do a lot of first-time home buyers. So,
So the first time home is 580 credit score. That's
right,
not that high. Say they got a decent job.
right.
What are you looking out of pocket cost to get into a $300,000 house?
So today you're probably looking at 3 to 3.5% down payment. So that can be, on a 300,000, anywhere from 9 to 10,000. Then you have your closing costs that are involved, which I would say probably anywhere from, $7,500 to, $9,500.
Mm-hmm.
So you can get into a home with, less than 20,000. There's also these down payment assistance programs that are helping a lot of buyers out there.
Is that like a cash at closing program from the seller or third party programs?
So these are third party programs through the state of Illinois, through like Cook County's got one now. So there's, the counties have different types of down payment assistance programs.
So these are programs you're familiar with that help alleviate a lot of the upfront costs. So instead of it being 9,000, maybe it's 5 or.
Well, yeah, if it's nine, well, you can use that money towards down payment or closing costs. So if you're looking at a $300,000 house
Mhm.
and the down payment assistance program is 10,000, so you're just basically bringing in the closing costs, to the table, and
Yeah.
that assistance is helping you cover the down payment. Yeah, there's this market's pretty crazy right now. And here in Illinois, the Chicagoland area, obviously it's a seller's market. Depending on where you're looking, things
Yeah.
are going quickly. So if you're putting in an offer to a seller and you've got a lower, down payment, they're going to take that into consideration. They're going to look at everything. I've heard, real estate agents, hey, I've got to sift through like 15 different offers. So if we're
Mhm.
submitting an offer with a, lower down payment, obviously that's going to play a role in this.
So those first time home buyers right now are probably having a hard time because there's so much competition with strong financing.
Right.
Not that first time isn't strong because it's government backed.
Right.
If you have a first time home buyer coming to you, what's like the least amount you've seen them have to come to the table with cash?
I mean, we've done deals where people don't have to bring any money in other than their earnest money. Let's say it's $1,000, and you may not see that right now during this time of year, like in the summertime when things are
Mm-hmm.
really going quick, and it's really a seller's market. But I see that more so in the fall, winter. Things might be sitting a little bit longer. That seller is willing to accept, and negotiate. Hey, I'll give you a credit.
Maybe a couple of deals fell through
Right. Yeah. So
at the end of the season because right
yes.
now we're at the head of it.
Yes. So I see that there's a lot more opportunities for those first-time home buyers or those FHA buyers in the winter markets, because the people that have already done their thing during the summer and spring.
Yeah, so some people they test the market. A lot of people list things emotionally.
Mm-hmm.
I mean, I don't know how you can't.
Right.
Right? We're emotional people. But if they don't sell or there's just not that right buyer, it lingers. And after 60, 90 days, somebody comes along and then they're more likely to accept that offer, entertain the details of negotiation.
Yeah.
That's
absolutely.
interesting. So 25 years, you've seen the ebb and flow. So you
Right.
see it as kind of like an annual pattern. And we were kind of talking about that before we started here.
Yeah, definitely. It's definitely an annual pattern. I mean, we're seeing year over year growth and, appreciation here in the Chicagoland market. You just see these lulls, in the winter, and then it'll just jump back up in the spring heading into the summer. So a little bit more opportunity, it's definitely a pattern. And, I mean, even dating, back into the, 90s, it's just always like that, during those winter months.
Yeah. It's like that across the board in a lot of things.
Right.
But I guess most people I doubt are being that strategic, right? And it's
Right.
probably a good idea to do that.
Well, some people have to move at a certain time or get the kids into school by
Yeah.
before the school year starts. So there's, you may, if you have the option to do that, you're probably going to see a little bit more opportunity to get into a home, but you also might not see as much inventory because people tend to list, after Super Bowl. Let's say that's
Yeah.
we're going to list after Super Bowl and heading into the spring, but that you may have more opportunity, but not as many, not as much inventory out there to view.
Yeah.
Yeah, so it's interesting.
Yeah. But first time home buyers, that makes a lot of sense, especially now. Right?
Right.
If you got the time, you got the ability to plan, it's always good to plan.
Oh yeah, for sure. If you have the option and if you got time,
Yeah.
some people don't have time. I mean, instead of going into a rental, or if you're, getting married, or if you have children, you need to move into something bigger. You may not have that kind of time. So everyone's scenario is going to be different.
There was this product that I don't know the name of it or what they called it specifically. I just dealt with it recently, where it was allowing a home buyer that's already a home owner.
Mm-hmm.
You have to be an owner first, so it's not a FHA. It's not a first-time home buyer.
Right.
But it was a program, and what they do is they underwrite the value of your house for the equity,
Mm-hmm.
and then they'll take like second position on it, and they will be the lender for the purchase of your new home. And they do that so that you don't have to have a contingency. And because they're going to fund the offer and they do it before like closing, and it's based on like previous underwriting on the value of your house,
Mm-hmm.
it allows you to come in with a cash offer, even if you're not.
Okay.
What, have you ever seen that or heard of that?
Yeah, that's going on a lot. I mean, there's a lot of that going on right now. So there is a program out there that if you have the equity built into your home, it's kind of like a bridge type of financing where you're
Yes.
going to use that equity of your departing residence and use that to purchase your new home. Now we've got a program at Fairway called our, it is a bridge loan buy now, so later. So we can utilize that equity from that departing residence for the down payment on the new one. Plus you can go in non-contingent, because this market, if you got a contingent offer, it might be difficult to get your offer accepted
Or looked
So,
at?
Yeah, it's, people don't want to wait till you sell. We know it's going to sell, in this market,
Right.
but we're going to take another, the seller's more prone to taking another offer where they don't have that contingency. So this
Right.
program eliminates that. It allows us to go in non-contingent and use the money for the down payment of the departing resident, use equity for the down payment of the departing residence.
So it's kind of a, what do you, I mean, it is a bridge loan,
Right.
but it's like a HELOC bridge loan, but it's not a line of credit.
So the way it works is, let's say someone is going to sell their departing residence for $300,000.
Mm-hmm.
They owe about $150,000. Well, we're going to lend up to 80 or even 90% of that $300,000. So 80% of 300 is 240.
Mm-hmm.
After you pay off the first mortgage of 150, you got $90,000 to pull out, put that money down on the new place, and then, you'll be able to go in non-contingent. We give the buyer 6 months to sell that departing residence. So they're not paying a mortgage on it. Interest is accruing. More than likely, they're going to probably sell it in a month or two because of the market we're in. But that is how that program works. Yeah.
So you call that a HEB? What do you call that?
No, it's just our bridge loan. Buy now, sell later.
We're going to call it a HEB.
HEB.
Because it's based on the equity. Because you get bridge loans that aren't equity based. They're based on construction. They're based on a ton of stuff.
Right.
But it being specifically based on the equity, I think, is a unique factor that's worth calling out. Especially because a lot of people that aren't in financing,
Yeah.
you hear the term bridge and they're like, I'm not.
Right.
Yeah.
So it's a unique product that we have here. We underwrite it in-house, which is awesome for our real estate partners, our buyers, because we control the process. Some other companies don't have the ability to do that, or they have to pull out a line of credit on that departing residence, then they can list the home. So there's some workarounds, but it's nice to have everything done in-house here at Fairway, yeah.
Yeah. So then that probably helps them save on their fees, right? Because you're gonna do 2 loans. So right.
So there is a cost, obviously, to do the bridge loan. They're going to save because, yeah, they don't have to, not only will they save money, but they're going to save some time. And, you know, I'm doing this right now in a couple deals, is we're using that bridge loan as a backup, you know, that way we can put in an offer non-contingent. The game plan is for that person to sell the property, which they more than likely will. But, you know, we'll go ahead and start the bridge loan process if we see that this property, you know, their departing residence is sitting a little bit longer, and then we'll jump in and start the bridge loan. Yeah.
Or maybe they want to rent it.
Well, that's the thing. So if you're going to, you know, obviously rent that property, that departing residence out, you can't do the bridge loan option at that point. At that point, you're probably just want to pull, you know, a HELOC out and then use that money for the down payment on the new one, and then just hang on to that and rent it out.
And it's probably better to keep it all at Fairway or one location, right? Because they know what's going on. They're going to be first in line for whatever, second. And so it's probably good to keep that all in-house, right?
Yeah, absolutely. Yeah, we know what's going on. We underwrite it, and, you know, we know what's going on with that buyer scenario.
If you deal a lot of first-time home buyers, you probably don't deal with a lot of investments, but I do know there's like a big push, what's it called? Like hack, that you get that FHA, you get a 4 flat and you live in there, right? Do you have that customer base coming through?
So we see a lot of that. You know, we have an online presence. So I, you know, do some YouTube videos and, you know, social media, and other people see, you know, what's going on out there. They're just scrolling through social media, and that's
I see you.
You see me.
I listen. I've been listening to the rates.
Nice.
Yeah.
But yeah, that's, if I was, you know, going back to, you know, when I bought my first home, if I, you know, would have done it right, you know, I would have probably purchased a 3 or 4 unit as my first home, lived in that property for 1 year, you know, collected rents from the other 2 or 3 units and lived in 1 unit. That way you're just building, you know, wealth. You've got a couple doors under your belt. And then at that point, you know, step out and take that next step and buy another property. But yeah, that's a house hack you see out there. You know, if you're a first-time home buyer, utilize the FHA loan. It's minimal down, even on a multi-unit property, as low as 3.5%. Rent the units out, live in one for a year, and then, you know, move on to the next one.
Yeah. That's such a good move if you're early on.
Right, starting out.
Or if you live with your parents and you say, hey, instead of buying a little condo, a lot of times you can get a 4 flat or a 2 flat or a 3 flat.
Right.
And now most of your mortgage is subsidized by the tenant. I know subsidy refers to government funding, but you know, it's offset.
Right.
So yeah, I wish I did that too. That would have been, you know, I had an investment, but it was just 1 unit. And then I says, man, I could have.
Right.
But
when
it was
look back.
Yeah.
Hindsight's always 20/20.
Yeah, exactly. But it was in 2008. So I probably wouldn't have got the loan no, you know, after.
Right.
They were giving out loans like nothing, right? I mean, that's
yeah, it was wild. I mean, you know, you stated income, stated assets. They had a program called the Ninja, no income, no assets, no job. It was wild.
Stealthy.
Yeah.
Ninja.
Yeah, and I just, you know, investors were buying it, and that's, you know, kind of like how you see it, you know, saw it on The Big Short, you know.
Yeah.
They were allowing this to happen, and, you know, buyers were out there, and just like in the back of your head, this person doesn't show income. They're not putting, you know, money down. It was different. Now it's completely different. You know, we want to make sure we're reviewing your credit, your income and assets, making sure you have the money for down payment. It's sourced, you know, where is it coming from? We just dig a little bit deeper. And a lot of people, you know, they feel like it's too much documentation, but, you know, it's just, you know, protecting, you know, ourselves and the investors at the end of the day.
Yeah, for sure. Having a good PFS, I think, is something that most people don't look at or think about. But like keeping it up to date, even if it's small, it's like a resume. I think people invest in a lot of things if they have that luxury, or, you know, they find themselves in a position. You got 401ks, you got Roth IRAs, you got a lot of different things. And I think it's really important to have something in real estate, even if it's with a group or like a REIT or something, because that it's like it's ingrained into one of the main sectors. Like you got to
Right.
be diverse.
It's something tangible. You own that piece of land, that property that, even if, like you said, if it's through a business or a capital group, you've got a piece of real estate that you can go to and, not just in the market.
Yeah. Yeah, I think that's it's good if you can, I think, to try to get into it
Right.
in some capacity. There is that thing called, I think it's Acorns, which is like you invest in the stock market, right?
Right.
I saw something about like tokening real estate,
Really.
which was briefly on my Instagram. And I think it was like along the same lines. Are you familiar with like what a REIT is?
Yeah.
So I think it's kind of like you build a REIT, except you sell the shares like for dollars, right?
Okay.
And then I guess depending on your REIT, you have your financials and you have your rate. What would you do? 7, 8, 9, 10?
Right.
What can you expect on real estate? In the real estate, it kind of fluctuates a lot with the loan industry, right? Because if you have enough money to purchase a building, it's dependent on the rate. And sometimes if the rate is so high, you say, I'd rather just loan money than have to operate a building.
Right.
So they seem to be very tied together and they move up and down. But being able to like own and operate a building, or even just operate and maintain a building, but not necessarily have that total liability, because a lot of people, like, they get a building, it's like a lot of pressure,
Right.
So it was like a way to let people in. I thought it was called tokening, but it was something I was wondering.
Yeah, I've never heard of that. Yeah, I know the whole Acorn thing, but it's kind of like what you're talking about, similar to crowdfunding, getting money from, the consumer out there to purchase those REITs at a smaller scale.
Yeah.
Yeah.
Yeah. And obviously you want it to do good. It's got to have a history of doing well, because it could be like anything, like some fake Bitcoin that people lose. Like, I don't know much about it, but
Right.
it's like anything, right? You should have a good understanding,
Yeah.
hopefully, and know who's involved.
Right. Well, now you can buy all the, outside of Bitcoin, like these tokens online. It's just like, what are you buying? It's nothing, tangible.
Yeah, non-fungible assets.
Right.
Yeah, that's a weird thing, right?
And it's a weird market. Stay away. I would stay away from it.
Yeah. Yeah. I wonder though, because maybe a little bit, something a little
risky.
I think it's risky for sure, but it would be nice to have something digital, a little bit of money.
Right. Into the Bitcoin. Right.
I think the Bitcoin, yeah. That's what I've been hearing. All the other stuff.
Diversify.
Yeah. Don't worry about, but the Bitcoin, maybe, who knows?
I think it's here to stay.
Yeah. You know what I think is weird, which I don't really understand? I don't understand how it can be traded like currency if it's not currency, because you can't have two currencies under a federal government. They control the currency. So you're like trading like it's value, but you're trading it for products. So there's no exchange rate. Like there's no barter tax or anything like that. It's like in purchasing with it. I'm sure you still pay sales tax and things like that.
Right.
But they're like, oh, it's a digital currency. Everyone's against digital currency. Now, fundamentally, I know they're structured different, but how is it different than just buying something with Zelle? How is that not digital currency? You know what I mean?
Right. I just think with the Bitcoin, there's more fluctuations up and down. Kind of look at it as like the complete opposite of gold. People, you go buy things with gold or, but some countries, that's their main currency is Bitcoin.
Really?
It's why, like in South America. Yeah.
That's what they use.
Yeah. It's crazy.
Yeah. I don't know too much about it.
Right.
I would like to. Did you try anything with it ever?
So we monkeyed around. Yeah. Bitcoin, have a little bit of it and, other cryptocurrencies. So, it's just kind of, money that you don't need or money that's just, sitting aside and, like I said, diversify. It's a little bit more risky, but, played around with it a little bit. Yeah.
Yeah. That's cool. I'd like to do it. Someone was telling me they wanted to pay me in Bitcoin for a small job, and I told him, I was like, I think you got to pay me like 150% of the value. He's like, why? I'm like, I don't understand it.
Yeah.
Like, I don't, or just cash it and give me the cash. He's like, no, you should do it. Like, you got to get into it. So I might take it as payment for like a little
Right.
side job for this person of mine. We'll see.
There, you can just liquidate it right away, once you get it.
Yeah. I like the idea of it because you can't play. He was like, okay, sign up for these, I guess apps or
Right.
softwares. And then you could see, because until you jump in like this, you don't know what it's about, but it's good to start somewhere. Obviously you started, I'm slacking. I got to get on it.
Yeah. There's all sorts of crazy apps out there where you can, trade different types of coins and different types of cryptocurrencies, but
Yeah.
get into it.
Yeah.
Fun. A little bit of, extra money on the side.
So it's working for you. That's what it means.
Yeah.
That's good. My buddy was saying the same thing. He's like, it works for me. I don't know how, but it does.
Right.
And it's interesting. It's very interesting.
Mm-hmm.
So you deal new time home buyers, a lot of investments.
Yeah, we've got a group. Yeah, we deal with a lot of investors. We deal with like renovation types of financing, new construction from the ground up. So we're expanding into that. And, there's a lot of buyers out there that, or even first-time home buyers, they see some properties, it needs some work. The property's been sitting a little bit. We can come in and, show them, hey, this is what it would look like if you went in there and renovated the kitchen or, finished, the floors or redid, the backyard. So there's products out there that we have that will help them make it their dream home and, on a property that's, probably, just got to have that vision when you're out there looking at places.
For sure. Like
Yeah.
Property Brothers.
Right. Yeah.
You can do it yourself though.
Right.
But you guys, what is that? What kind of product is that called?
So there's two different options we have for someone who's going to live in the property and use that as their primary residence.
Yes.
It's a government-backed loan, FHA 203K. So that's the renovation loan combined with the FHA loan.
FHA 203K is a self-purchased and renovation financed government program.
Right, government-backed, yeah.
Okay.
FHA. So yeah, you can put as little as 3.5% down of the purchase price plus the cost of rehab.
Who determines the cost of rehab?
So our buyers, we let them know, before you're going in and put in a property or put in an offer, get an understanding of how much it might cost you to fix it up. Maybe bring a contractor with you, within the first week of going under contract or before you go under contract to understand what that cost might look like. Now it's the agent's job to help us out and determine, hey, if this person's putting in 50,000, is it going to be worth it? Is the after repair value there? So we make sure we have a deal. So if someone finds a place at 250, they want to put 50,000 in, we need to make sure that that place is worth $300,000. And our appraiser is going to go out there and, confirm that. They're going to review the bids from the contractor to make sure we've got everything we need to, if you're adding a bedroom or just updating stuff, we need to make sure the value's there after the fact.
And is there anything like that that's not like a first time home? Like, do you have programs like that? They require a lot more down payment, 20%, 30%.
So we have that type of program it's a conventional product, a conventional financing product for investors. It's called our Fannie Mae Home Style Loan.
Okay.
So now you're talking 20% versus as little as 3.5%. So an investor can come in there, same scenario, base it off of 250 plus the 50 to rehab, then they would have to put 20% down of that 300,000. So we've got products available for investors and first-time home buyers or any type of home buyer for that renovation piece.
Let me ask you this: if you have a situation where they anticipate the value to be 400,
Mm-hmm.
but they're going to put in 60, that they could somehow come in with nothing down, or does that take a strong confidence or a relationship or some underwriting that?
Well, even if the after repair value is higher than what the cost of the home plus the rehab is, we still base it off of renovation plus the cost of the home. After repair value, it's great. It's there after the fact. If you want to pull cash out in 6 months after you close, you have the ability to do that, you know the equity's built into that property.
So you would do like a cash out refi after that.
Right. 6 months after you close, after you do the renovation.
Okay.
Right. So
Oh.
it's finding, finding those properties out there that you feel, and we see it all the time. We see properties that have been sitting there. They need a lot of work. I mean, people that are buying properties now where you're getting those multiple offer situations and, an agent's got to review 15 different offers. That property is probably move-in ready. No work is needed. I mean, it's just,
Yeah.
get your stuff in, your family's in there. You don't have to do anything. Where those other types of homes are needing some love and, they may have been sitting. You might get a good deal on them.
And then you got the other side, which is what I look for. The ones that scare the shit out of people. They look like they're going to fall over.
Ones that got a family of raccoons living in there.
Yeah. But those go quick too.
Yeah.
Those go quick too, because there's a lot of people that know what to do with them.
Right.
And they don't sit.
Yeah. We've seen it all. We've seen those properties that, rodents in there or, just ceilings falling down, mold everywhere.
Yeah.
Those are probably properties you're like, yeah, I love this opportunity.
Oh yeah. Go in suited up.
Right.
And good to go. So part of your customer base could be, I guess, like rehabbers, right?
Right.
Guys that go in. You're going to need probably 60 to 100 grand cash though.
Right.
That's the thing. You got to have that liquid to be able to take that risk.
Right. So we have an event coming up in July. I'll invite you to it too, July 23rd, where we've got a referral partner of ours who this is what he does. He's a property manager and, he flips houses or buys and hold. So it's called, find, fix, finance flow. So, investors out there that want to come learn a little bit more, we have that, we do a lot of educational stuff, but, the programs are out there. It's just a matter of finding the right homes. And
that's a really good one. And I'll tell you, I think that's something I'm going to help promote if I can. I don't know how, but I think there's a lot of guys in my situation that are in the trades that are either a really good electrician or a really good plumber or a really good window guy, which I know. And that's what they do. They go after these houses, and a lot of them are like, oh, I got to just pay. I bust my ass and I pay. Whereas like you go to the seminar, I'm sure they'll see the process. Yeah, money costs money, but time is money.
right.
So maybe you find yourself in a position where you don't have to kill yourself when you're 45 and 50 with the labor. You're still going to need to put in the time,
Right.
but you don't have to kill yourself with the labor unless you're looking to, and then you get that bonus. That's kind of the way I look at it. If it's something like, if you're a tradesman and you want to get into investing, it's kind of like you're your own customer. No, you got to know how to do your numbers, but you get the bonus. Like you get to sell it.
Right.
And then if you talk to anyone that knows what they're doing, you never sell it.
Right.
You keep it forever.
That's cash flow.
Yeah.
Yeah.
Like, so, but there's stages to it.
Right.
It's good to see that. So
Yeah,
that's what you
depends
got.
on what's going on in the market at that time after you're done renovating. Hey, is it worth selling it right now? Or do I maybe, now that I've got that equity built in, do I take a little bit of cash out, collect some rent, build wealth, and then use that money to buy something else and just rinse and repeat, right?
Yeah. I think the mindset is like, worst case scenario, if I have to sell it, will I still make money for my time and get everything out? Like if I had to dump it, you say.
Right.
And if that's a yes, then you got to go to the seminar and take that chance.
Yeah.
Right?
Yeah, absolutely. Yeah, we deal with a lot of real estate agents that some don't even have their own primary residence. So we want to, show them, hey, this is, how to build wealth through real estate, or people that just own their, first home or own their primary. Let's show you what this looks like or how we can accomplish, buying multiple properties.
Yeah. I really like it. I like it mixed. I think it's, I got a buddy. He's like, yeah, I got 10 houses. I'm like, what do you mean you got 10 houses? Like, what'd you do? Did you get it? Like, how'd you do that? And he did that. He's like, I went on these forums. I joined groups.
Right.
Cause I'm like, like, who do you know? He's a banker.
Okay.
But he doesn't know much about real estate. And he's you got to be a risk taker. But if you don't know much about real estate and you're not a risk taker, but you're in the trades, I feel like it's the first step. Like I would rather do that than be in the stock market,
Right.
you know?
What you know.
Yeah, it's what you know. So, and then if you got to make repairs, you know all the guys that can do it. You can get it done inexpensive. I really think it's kind of like the tradesman first investment, and it's probably the businessman's third, you know?
Right.
And I want to encourage them to go because
Yeah.
I know too many guys that just wreck
Yeah, I'll send
themselves.
you an invite.
Yeah.
Yeah, it's for investors, for our real estate agents. I mean, for anyone out there that's just looking to, take that next step.
When is that?
July 23rd. It's on Wednesday, July 23rd. We're doing it at the old Top Golf in Wooddale. It's called Parlay 390. So we're going to have an event there, seminar. It's going to be an hour and a half, and then we'll have, rent a couple golf bays out and have fun afterwards.
Okay, cool.
Yeah.
We got to talk about that after, maybe,
Yeah, for sure.
because this won't show by then, but we'll get some. Maybe I could help.
Yeah, I'll send you the link,
somewhere.
invite you, come on by it, tell anyone that you know.
Cool. That sounds nice. The Top Golf, did they move? Weren't they in
So
Wood?
that was the first Top Golf, I think, I know definitely Illinois, but I'm not sure. It might have been the first Top Golf in all of the U.S. It was on Wooddale there, in
Yeah.
Wooddale, off of Prospect.
Yeah. That was the first one.
I think that was the first Top Golf, and then obviously Top Golf expanded, blew up. Now it's all over the world. But yeah, it's Parlay 390. I think the village of Wooddale took it over and converted it. But yeah, it's a good time.
I heard they were getting a big taxed. They were getting taxed.
Oh.
I don't know. It's a lot of land.
Yeah,
It's a lot of land. It's cool, the double decker and all that. I didn't know that was the first one.
yeah,
I like that. I love that. It's always nice when like things pop from local,
right.
like Portillo's,
Yeah.
McDonald's. I mean, those are those are big things, you know.
Yeah, absolutely.
Sebastian Maniscalco,
Michael Jordan.
Michael Jordan, right? There's a lot of good things in the Midwest, I think. A
Yeah,
lot.
for sure.
You know, we talk like, I always say like this is like a working city because there's nothing that like is inflating the economy. If anything, it's the opposite. And I think like California, you have like, or you had historically like media production that inflated the economy.
Right.
Billions of dollars. You're selling an hour and a half dream that makes you laugh, that makes you cry, and you got tons of money. And you kind of look at LA and it kind of like looks like it bit him in the ass a little bit because they kind of went nuts with the whole gender ideologies and it messed up a lot. And people like fled.
I was just out there last week or 2 weeks ago out in LA, and a friend of mine is in that industry, and he said a lot of even the actors and actresses, celebrities have been moving out of that area, out of the Hollywood area or LA area
Yeah.
because of what's going on.
Yeah.
But it's not as glamorous as it once was.
I don't know if it was ever glamorous. I went there once. The first time I went there, I went to Hollywood, and man, I was so underwhelmed
Yeah.
by the sign. I'm like, that's it.
Right.
There's still like old shitty like murals with all the paint coming off the wall and homeless people and garbage and you know what I mean. And MGM Studio was like, it was like a part of Elk Grove. There's like there's 16-foot high fences. It wasn't that glamorous. It looked like Itasca, you know. It's like nice. There's not really big buildings because of the earthquakes, or there wasn't when I was where I was at. I'm not trying to put down LA. I love the tropical, but I think it's like propped it up. And same thing with New York. So like Chicago, I think in the Midwest being the center, it's kind of like this hub.
Right.
And we have the ability to do like a lot of work and get a lot of things actually done. And I think we do.
Right. Built on hard work, blue collar, and
Yeah.
And then when it comes to real estate, we didn't see the swings that we did in California, Arizona, Florida, Texas. It stayed steady, which is why I think we're seeing the market we're in right now here locally, is because we didn't see that doubling in value like we did other states, and things are just steadily increasing here. And we're not, we don't see that, inventory like we do in other areas in the country.
I think people are moving in to the Midwest.
I don't know. I think people are still leaving, Illinois, but
Is it because we got high taxes, right?
high property taxes. I mean, obviously you can get into the politics of it,
Yeah.
but high property taxes, taxed on everything now, right? Well, obviously more taxes on everything, gas, people,
Sugar.
sugar, cigarettes, food. I mean, your restaurants, your additional taxes out there. Yeah.
And we got Elon Musk and Donald Trump to
Yeah.
save us.
They're going at it now.
I know what happened. I was so happy they were friends, and they're not friends.
I don't know.
I don't.
I
either.
kind of stay away from the politics. I don't,
Yeah.
not my forte. And just, I know no matter who you got in office, there's always something going on that's, we feel is not right.
Yeah. Right. I feel like if you'd have to dodge a bullet, if you dodge a bullet, then you gotta get respect.
Right.
I don't care how everyone's kind of shitty in ways they don't understand.
Right.
You know what I mean?
Oh, 100%.
Like he got clipped
Yeah.
by an assault, like by whatever, I don't know,
Right.
a sniper or something. That's wild, He's going fight.
Loved it.
I
Yeah.
mean, you gotta love it,
Yeah.
regardless what it's such a good thing, and who knows, like geopolitics and all this nuance. I mean, really, it's a big guessing game for everybody.
Right.
There's no way to control it.
Yeah, that's above our pay grade, all that stuff going on over there. Yeah.
Yeah, but it doesn't
It
necessarily.
all affects us, though.
Yeah, so I was gonna
Yeah.
say, the rate. That's what I was saying. I listened to you about the rate.
Right.
What is the rate at? What are we looking right now? Do you have any idea?
I mean, mortgage rates, like I just did a video. It's like, the weather, it could go up and down, who knows what the predictions are. Fannie Mae and Freddie Mac are, they forecasted us at 6% by the end of this year. In June, just last month, they said, okay, well, we're making an adjustment. It's now 6.5. So that's what they're forecasting by the end of the year, a 30-year fix at 6.5%. There's a lot of different factors that play a role in the interest rate. Is it your primary? Is it an investment? What's your credit score, your down payment? There's so many different factors. Even income and where you're buying play a role in the interest rate. So for someone with A credit, putting 25% down, yes, you may see like today 6.625% with 0 points.
Wow.
But for an investor,
You're really going to see that? Or is that what they show you? Is that what you see? And then do you pay 6.5 or 7?
No,
do you think
we've quoted, like yesterday, 6.625. They had great credit, 780 and above. They were putting 30% down. So all of those play a role in the interest rate.
Absolutely.
Yeah.
30%.
Right. So you're less risk,
Right.
better interest rate.
That's a good number.
Yeah.
6.65.
Right. Or, if you're an investor out there, putting 25% down, you may see a rate in the high sevens. So as you can see, there's just a wide array. Or if you have a program that's outside the box, like let's say we qualify you based off of your bank statements and you don't show income on your tax returns or your W-2s and pay stubs. We have those types of programs, but you're going to pay maybe even a higher rate into the 8s. You don't have the ability to show income conventional,
Right.
and we just use like different routes to calculate your income.
Yeah. Income is a big thing.
Yeah.
That's the underlying.
Ability to repay. That was the big thing when they made that change. The government, that was the rule. We need to show that you have the ability to repay a mortgage. Back in the mid 2000s, you didn't have that. It was, can you breathe? Are you alive? And there's
Can
the
you
money.
sign?
Yeah.
Well, it was supposed to be like buyer beware. But on a large scale, buyer beware means the economy the banks took the hit because they gave the money.
Right.
And ultimately, you can't go after people that don't have any assets. I mean, a lot of people, that's their main asset, right?
Right. Well, it caused a mortgage crisis. You lent money out to people that could not pay. Values immediately dropped. People lost that asset.
Yeah.
Foreclosures, short sales, things like that, just changed. Everything. It was the Great Recession.
It feels like that sort of scenario is kind of being held at bay right now through better just planning, more strategic outlook, I think, because putting the rate higher was probably a good thing, right? Because otherwise you'd have housing. I mean, the numbers wouldn't stop.
Right.
So who's going to not take money at 3%?
So yeah, that was during the COVID years.
Yeah.
2020, 21. You had rates, a 30-year fix down to 3%, 15 years at 2.5, 2.25. it was, free money. It went down so fast. It boosted it boosted home values. You saw 15 to 20% appreciation, which is, I mean, year over year, figure that, in 2 to 3 years, I mean, you're doubling home values. And if that would have continued, I mean, at that rate, it was just, it would have been bad.
Yeah. Yeah. It seems like you got a lot of people in those loans now that you just have to keep moving. So sometimes you have to get out of them.
Right.
And you got to take that principal reduction that you had and whatever and sell it. But I wonder about how the economy actually is as far as like buying power of the people, because it's a seller's market,
Right.
which means if you have a move-in ready spot, it's going like
Right.
like that.
Yeah, it's that lock-in effect. If someone has that 2 or 3, 4% interest rate, why move? They don't, they have that low interest rate. They got that lower payment. But some people, they have to move. They, there's death, divorce,
Right.
Kids. So, sometimes you do have to make that move. Or if you've got that interest rate, you have a ton of equity in your homes. You bought in 2020, 21, 22 even. I mean, you've built a ton of equity. So use that money to put down on something so you don't have that, maybe that big of a loan amount, or utilize that equity to pay off other bills, or utilize that equity to buy investment properties. So those people are in a good spot right now that have that low interest rate because they've got options.
What are the HELOC rates at? Can you get a HELOC at 6.5?
Your HELOC is kind of based off the prime rate. So, your HELOCs are going to be anywhere in that mid-7 range,
Okay.
Right. We're doing a lot of second mortgages right now as well. So, fixed second mortgages for our, buyers. I mean, people want to go ahead and tap into some of that equity and utilize it to, either pay off credit card debt or, purchase another investment property.
The fixed second mortgage, what is the rate? Is that a better rate because it's a second mortgage? I mean, what's the difference really?
So a line of credit, a HELOC, is kind of like a credit card backed by your property, using the home as collateral. So you can pay it off and then reuse it, where a fixed second mortgage is at a more than likely a lower interest rate than a HELOC.
Mm-hmm.
It's fixed for 10, 15, 20, or 30 years, depending on what you decide on. So you got $100,000 fixed second, they give you the 100,000, and then you're paying it back over time based on the term you select.
So if you got in a really low rate and you got a lot of equity, probably if you need some of that cash and you're going to put it to work, the second mortgage is a really good option, right? Because you get to keep
second
it.
mortgage or a HELOC. Yeah, the HELOC can adjust up or down based off of prime rate. We saw that, obviously, as you can see, when the Fed says we're going to adjust interest rates, or we're going to, hold the Fed rate steady, that affects that line of credit directly. So, right now it's higher than it once was, 4 or 5 years ago.
Yeah.
Yeah. So, but that's why, when the Fed says they're going to keep rates steady or hold them, it affects that line of credit directly. Yeah.
Right. It makes me think about there's like a tipping point in the rate, right? Because once you start getting 8, 9, it's like you could loan money at the same, and obviously there's risks to loaning money,
Right.
but at the same return rate as you can expect from a lot of property, right? Like what do you think? A lot of multifamily or things like that, it's like a long-term play. Like your return is probably around 7% if you're doing good, 7 to 10, you're doing
Right.
great. So if you got to get a loan at over 7, it kind of like puts the cap on using that money to go and get investments with it.
Right. Is it really worth it?
Right.
To utilize that money and pay, that higher percentage.
But now all the rental prices are going up. So maybe it's starting to become worth it again. Maybe you're going to see higher, returns at the end of the year.
Well, we've seen rents rising, year after year. So you're seeing that those rents rise. I mean, that's why we kind of, trying to educate our borrowers. Hey, why look at renting? Let's take a look. Hey, you can get into a property with as little as 3 to 5% down. Does it make sense for you and your scenario to rent versus, buying that? Because rents are rising everywhere. Or at least here locally. Yeah.
They are. No, they definitely are.
Like at what point do you think it makes sense to buy a property? Like when you're collecting the rent, does it pay your taxes, principal, interest, taxes, and insurance? Is it break even? Is that the
If you're ever paying rent, unless, I mean, in most scenarios, if they're being properly ran, you are paying all the mortgage, all the taxes, all the maintenance, and hopefully a profit of some small amount. And when I say maintenance, you got to infer deferred maintenance.
right?
So if you got that covered and you're cash flowing, that's
That's a no-brainer.
a no-brainer. But you don't want anything that's not that. I mean, you're really playing a risky game if you're like, oh, it doesn't make money, but it's Chicago, so it's going to have equity in 10 years. I mean, if you got, I don't know, people play those games. I'm not that sophisticated into it, but there are areas of downtown. There's certain areas that are worth a lot of money.
Right.
And even if it costed you money to carry it, the equity alone, because of inflation, like it could do something for you. But from where I stand, I wouldn't feel safe. It's got to cash flow. It's got to do all those things for
Right.
sure.
Yeah, as an investor, it's got a minimum break even.
But what that means is anybody that rents can afford a house if they can afford the down payment.
Right.
So what it comes down to is like the cost of money. If
Mhm.
money was free, everyone would go and buy because they can afford it. Obviously, they're paying, someone else is owning the building, which is kind of interesting if you token out a building. Then it turns into a condominium sort of situation. I mean, maybe you own part of the building. I know there are some things like a co-op or something like that you read about and you're like, no one's doing this shit. But it made sense at some point, and in the future, you never know what makes sense.
Yeah.
Diversifying risk, all that. But I think, yeah, for sure, if you can get that 3%, you got to show up and get a house.
Right.
If you could get that, my wife bought her first condo with $10,000. She bought the appliances. She had a couple thousand left over. So she got into a small condo. She could pay the association dues. I would suggest getting into a house if you can. Doesn't matter how small. You don't see too many 2-bedroom houses. I bet you we're going to start seeing 2-bedroom houses in developments because you could just sell them so easy and you not get too much more for the 3rd bedroom. There's you never know. There's always a good formula.
Right.
Oh, what do you think about tenants becoming homeowners? Like, how does that transition usually happen? You get a nice job. Who do you see? What do you need?
I think it's everyone's scenario. Like, how long is a person going to be in that area? What does their job look like? Like, what is their, income at? Is it gonna sustain, or like what type of job do you have? Is it commission based income? I think everyone's scenario is different, but it's about educating them on like what makes sense for them. Here's what the payment looks like in a certain area. Here's what your rents are going to look like. Like what makes sense for that buyer. Yeah, I feel like we don't want to push people into buying. We want to educate them on the pros and cons. And there are cons. If someone's going to be living at a property, or if their job is going to move them in 2 or 3 years, maybe renting is the option to go with. So you definitely don't want to push buyers into buying just because of the whether it's the commission or just to get them into a home. We want to educate them on what that looks like as a homeowner.
Make sure it's the right choice for them.
For sure.
A lot of people probably do like to rent,
Yeah.
not own. There's really nice places in Elmhurst and a lot of towns.
Right.
People just rent.
They have the amenities. They don't want to deal with it, or if it's just maybe temporary for them too.
Yeah, I think a lot of play, if you don't know and you're younger, the best thing to do is not use credit cards, keep your bills as low as possible, try to save communion money, whatever it is. Because 10 grand's not a ton of money. I mean, you could bust your ass over a summer as a high school kid and then get a decent job where you're, at a big company where there's benefits,
right,
and get into a home early on, and for most people, like my wife and I, like the equity in that condo was like the bonus, when it came time to move.
Yeah.
And if we were paying someone else's rent, it would have costed us more. All you need is that little.
Yeah, you wouldn't have had that down payment or those additional funds to do whatever you want.
Yeah.
You just can't, when it comes to, plus, sometimes renting, hey, I want to test out that community or just see if it's right for me and my family. Or if you're a single person, I didn't like Elmhurst, maybe I'll check out Bloomingdale or LaGrange, or you have those buyers out there, or those people too.
Those customer
Right.
base. For sure.
Just unsure, afraid of commitment.
Afraid of commitment.
Yeah.
That's a
It's a
thing.
big move.
Yeah, it is. For sure. It's like buying a building or buying something, right?
Right.
Or Bitcoin. All speculation until
Right.
I go and sign up.
Yeah.
So you think it's a good way into the FHA coming to this seminar? This seminar is more for investments.
So this one, so we do at my branch, we got our offices in Elmhurst. Our big thing is educating our referral partners, our agents, and insurance people, anyone within our spheres of influence. So our big thing is educating them. So we have events like once every month or two. This one is geared towards, people that want to learn more about the fixing and finding and, flowing that, cash flow or flipping that property. So we bring in speakers and, like we had one about AI, and, for our referral partners and how to utilize that. This one is specific to investors and real estate agents who want to expand on their real estate portfolio through investment properties.
Okay, yeah. That sounds very, very like informative.
Yeah, it's right up your alley.
It is, yeah. What does it cost?
There's no cost to us. We have sponsors, that are in our mortgage world that help us out with the cost of that, and so there's no cost to it. We just want to make sure we provide value, fill up the room, and obviously in return, if someone needs a mortgage or like looking for guidance, our names are out there to refer back.
Yeah. I mean, I think everybody that's in business or wants to be in business needs money, needs capital.
Mm-hmm.
And they need to look at it like liquid, like water. It's like it performs a function and it needs to be fluid and move. And there's always a cost to it. And I think there's like a stigma around it for a lot of people that are not in business. It's like, it just looks like debt. I just owe this debt.
Right.
And it's like, how does it work? When really it's about ratios. And I was saying, like, I think money is like, there's like AC and DC, right? Current and electricity. We'll go from water to electricity. So the DC is like direct current, right? Doesn't stop. The water keeps flowing. You have a business, it's always making money. It's bringing money in. You have a sales business only. You're only selling a product. You don't have any, let's say, subscription-based products or things where there's annual payments. Right. It's AC. It's alternating. It's money on, money off, money on, money off. And in society, we have both. And I feel like the bank money is kind of like that direct current. It's money coming in. You use it to build a property. You use it to pay the loan. And it's money that goes out. So if not just about investing, but understanding how to utilize money. Like you've told me a lot of products right now that I'm very interested in understanding more about as like a developer or someone. Because say I have a customer, maybe they want to do a renovation. Well, I know what it's going to cost. We could look at their home equity and very easily you could get them a HELOC or a line of credit for construction, right? And being a builder, knowing what that product is, having your information, mentioning it to the customer. Now they say, yeah, we only wanted to spend $50 on the kitchen. I know there's overages. Maybe we end up at $55. And now they say, okay, they got all this stuff set up just in case. And they say, oh, you know what? I want to go with the Sub-Zero. I know it's 10 grand in it. I would have never thought. Well, I like cooking. Let's get the Wolf stove, right?
Right.
So now it's like, what is it going to cost? I don't know, an extra $100 a month or something for on the loan, or we put it on the house, and it's definitely within our means. So it allows me to be able to work in ways that I can't. So I think more than like even doing flips or getting out on your own, just knowing what kind of like money is available for everybody is important for anyone trying to sell their services that aren't necessarily financing services. That's where you come in.
Right. Yeah. It's good to know your options.
Yeah.
Know what that, financing, helps you accomplish, leverage, whether it's, renovating your home, buying a business, or, that's how America's been built, right? On, utilizing what those financing options.
Yeah. It's true. I mean, America, the economy runs on debt.
Mm-hmm.
And does that mean that the average American that's participating in the economy should run on debt?
I think that's what we're doing, whether it's your home or, opening up a business. I mean, obviously the goal is to get that paid off, but that's how we get started.
Yeah. Cost of money.
Cost of money. Yeah. What is it? Does it make sense at, 7? Probably won't make sense, if you go any higher.
And you know what's good to know? That like, I don't know. I don't need to know. I don't ever have to know. Because if I come and I sit with you, I know you're going to bring up your sheets. You're going to do a little
Right.
bit of paperwork, and and then when I see it, it's going to make sense.
Yeah.
And I think getting over that is probably a big deal for some people. So
Right.
what's the name of the event again?
So it is on July 23rd, Wednesday. I'll send you the flyer.
Okay.
So it's find, fix, flip, finance, and flow. So the 5 F's. You got to find the property, then you fix it. We're going to help you finance it. And then does it make sense to flip it or flow it, cash flow it?
Okay.
Yeah.
That's awesome.
Yeah. We've got some good speakers coming in. We'll have fun and educate, everyone on the process.
So this is it. This is putt-putt golf, or what are we doing?
This is Parlay 390 in Wooddale. So we'll go ahead and do the seminar, have lunch, and then we'll have, we'll rent out a couple of bays. It's, like Topgolf, it's a driving range
Yeah.
on steroids.
Yeah, for sure. That's a lot of fun over
Yeah.
there.
So,
All right, cool. Well, we'll be in touch for
yeah,
sure.
For sure.
Hopefully you'll want to come on again, say
Yeah,
hi.
Great time and appreciate it. Awesome studio and looking forward to, coming again.
Thank you.
Appreciate it, Jono.
Thanks. Good to see you.
Thank you everyone for watching. See you soon.